that there cannot be any prearranged plan or oral understanding as to what specific assets can be invested in by the separate account. And, in a continuing series of private letter rulings, the IRS consistently applies a look-through approach with respect to investments made by separate accounts of life insurance policies to find indirect investor control. Recently, the IRS issued published guidelines on when the investor control restriction is violated. This guidance discusses reasonable and unreasonable levels of policy owner participation, thereby establishing safe harbors and impermissible levels of investor control. The ultimate factual determination is straightforward. Any court will ask whether there was an understanding, be it orally communicated or tacitly understood, that the separate account of the life insurance policy will invest its funds in a reinsurance company that issued reinsurance for a property and casualty policy that insured the risks of a business where the life insurance policy owner and the person insured under the life insurance policy are related to or are the same person as the owner of the business, deducting the payment of the property and casualty insurance premiums. If this can be answered in the affirmative, then the IRS should be able to successfully convince the tax court that the investor control restriction is violated. It then follows that the income earned by the life insurance policy is taxable to the life insurance policy owner as it is earned. The investor control restriction is violated in the structure described above, as these schemes generally provide that the reinsurance company will be owned by the segregated account of a life insurance policy insuring the life of the owner of the business of a person related to the owner of the business. If one draws a circle, all of the monies paid as premiums by the business cannot become available for unrelated third parties. Therefore, any court looking at this structure could easily conclude that each step in the structure was prearranged, and that the investor control restriction is violated. Suffice it to say that the IRS announced in Notice 2002-70, 2 degrees Celsius B. 765, that it would apply both the sham transaction doctrine and SSSS 482 or 845 to reallocate income from a non-taxable entity to a taxable entity to situations involving property and casualty reinsurance, arrangements similar to the described reinsurance structure. Even if the property and casualty premiums are reasonable and satisfy the risk-sharing and risk distribution requirements so that the payment of these premiums is deductible in full for U.S. income tax purposes, the ability of the business to currently deduct its premium payments on its U.S. income tax returns is entirely separate from the question of whether the life insurance policy qualifies as life insurance for U.S. income tax purposes. Inappropriate marketing. One of the ways in which captives are sold is through aggressive marketing designed to highlight benefits other than real business purpose. Captives are corporations. As such, they can offer valuable planning opportunities to shareholders. However, any potential benefits, including asset protection, estate planning, tax-advantaged investing, etc., must be secondary to the real business purpose of the insurance company. Recently, a large regional bank began offering business and estate planning captives to customers of their trust department. Again, a rule of thumb with captives is that they must operate as real insurance companies. Real insurance companies sell insurance, not estate planning benefits. The IRS may use abusive sales promotion materials from a promoter to deny the compliance and subsequent deductions related to a captive. Given the substantial risks associated with improper promotion, a safe bet is to only work with captive promoters whose sales materials focus on captive insurance company ownership, not estate, asset protection, and investment planning benefits. Better still would be for a promoter to have a large and independent regional or national law firm review their materials for compliance and confirm in writing that the materials meet the standards set forth by the IRS. The IRS can look back several years to abusive materials, and then, suspecting that a promoter is marketing an abusive tax shelter, begin a costly and potentially devastating examination of the insureds and marketers. Abusive life insurance arrangements. A recent concern is the integration of small captives with life insurance policies. Small captives treated under Section 831 have no statutory authority to deduct life premiums. Also, if a small captive uses life insurance as an investment, the cash value of the life policy can be taxable to the captive, and then be taxable again when distributed to the ultimate beneficial owner. The consequence of this double taxation is to devastate the efficacy of the life insurance, and it extends serious levels of liability to any accountant recommends the plan or even signs the tax return of the business that pays premiums to the captive.